In this episode, we are going to uncover the institutional traps of liquidity and guide you to become a conscious trader. Make sure you watch this entire video slowly until the end, and grab your notepad because we're about to equip you valuable knowledge. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel. Before proceeding to the liquidity patterns and liquidity scenarios that frequently form in the market, let's begin with a basic introduction to smart money and liquidity, and see what are the exact definitions of these terms. Let's imagine that major financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To do this, they require a significant number of sellers and corresponding seller orders in the market. This is essential because without available sellers in the market, no transactions can take place. Therefore, smart money needs to trigger the stop-loss orders that are already present in the market. In order to execute their buy or sell positions, it is often speculated that smart money may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. This situation creates an illusion among retail traders, making them believe that they are trading on the right side of the market. However, contrary to their expectations, the market moves in the direction of their stop-loss levels, and after triggering the stops it resumes its normal trends. To survive and thrive as a profitable trader, it is crucial to identify liquidity on the chart. These areas where significant volumes of orders are present can provide insight into market dynamics and help prevent substantial losses. Liquidity can be classified into two distinct types: static liquidity and dynamic liquidity. Let's have a brief explanation of both of them. Dynamic liquidity refers to the factors that influence the market direction and movement. In simpler terms, it represents the elements that drive market movements. To better comprehend this, let's imagine a market structure like a rally wave, consisting of a high and low. These highs and lows represent external liquidity. Essentially, external liquidity pertains to the highs and lows within a rally wave. On the other hand, the fair value gaps found within the range of the high and low are considered our internal liquidity. Price in the market always moves between internal and external liquidity. Imagine it like as a continuous circle, where price moves either from internal to external liquidity, or from external to internal liquidity. If we look at the schematic figure here, it shows a rally wave that moves upwards, sweeping the external liquidity gathered above the previous high. After this, the price shifts towards internal liquidity, indicated by this fair value gap, to fill the gaps left behind. From internal liquidity, the price transitions back to the external phase. Essentially, the price moves from the fair value gap to external liquidity by sweeping the liquidity above this high. With the external liquidity being swept, the price then aims to balance by targeting internal liquidity. This prompts the price to drop and fill the most recent fair value gaps. Let's move on to the static liquidity details. The static liquidity refers to the specific zones in the market where large pool of money is resting, such as stop losses, buy or sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweep as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Static liquidity can be identified in various areas on the price chart, like below equal lows and above the equal highs, above the swing highs and below the swing lows, below or above the dynamic trend lines and channels, inside the order blocks, below or above the support and resistance levels, in the Fibonacci retracement levels. Having a solid grasp of static liquidity zones reveals their profound impact on market price direction. Neglecting them can lead to substantial losses. Some of these zones and patterns are especially important as they're widely recognized by traders, attracting more stop-loss in pending orders, increasing the likelihood of price moving towards them to absorb liquidity. Let's now focus on practical liquidity patterns and scenarios that are more likely to drive price movements compared to other liquidity zones. Identifying the zones on our price chart enhances the reliability of our trading strategies, improving the probability of successful outcomes. The first practical liquidity pattern we should consistently seek in the market is characterized by equal lows and equal highs. As the term suggests, when the price establishes internal lows at the same level, we identify it as an equal low. Similarly, when the price forms internal highs at the same level, it's recognized as an equal high. Equal lows and equal highs fall into two distinct categories: double bottom or double top, and triple bottom or triple top patterns. Now let's delve into the specifics of each pattern and explore the psychology behind their formation within the market. Imagine we have a structure like this: price created a bullish break of structure, pushed upside and then retraced back down, failing to reach the demand zone generated by the BOS wave. Instead, the price formed an internal low. It attempted another push upward. But the bullish momentum was insufficient to break the recent major high. Subsequently, the price experienced another pullback and couldn't break the recent internal low, resulting in the formation of a double bottom. During this phase, many retail traders who base their trades on chart patterns entered long positions when they identified the double bottom pattern. They also placed a stop-loss order just below the equal lows, creating a significant liquidity pool. Consequently, as you can see, price experienced an upward rally movement, driven by the buying pressure of the retail traders who had entered long positions. As you are likely aware, smart money often manipulates the market, crafting scenarios that mislead traders into thinking they have a clear understanding of price action. Then, they lead them into traps to trigger stop losses and generate additional momentum. To gain a better understanding of the market manipulation methods that frequently occur, let's draw a bullish trend line by connecting the recent lows in the market. Many retail traders who use trend lines for trading view this bearish pullback as a breakout from the bullish trend line. They were eagerly waiting for the price to pull back, providing them with a selling opportunity. They believed that the market's bullish momentum had come to an end, and the bulls had lost control when the price broke below the trend line. These traders entered the market by taking short positions as the price retraced upward. They also set their stop-loss orders just above this internal high. Notably, the price showed a brief reaction to the trend line and experienced a temporary bearish wave. This reaction even induced more traders to enter the market by opening short positions and placing their stop-loss orders above the recent internal high. This course of action created a perfect buy-side liquidity pool here, waiting to be cleared by the market. Traders, I think this video is getting longer, which might make you bored, so let's see the left-out topics in the next video, which will be uploaded in few days. Watch the next video for clear understanding. Once uploaded, I will give the link in the description and in the pinned comment. Stay tuned. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. See you in the next episode.